Welcome everyone out in podcast land again for another episode of Money Talks
with the Wealth Whisperer.
All right. Today's topic is going to be pretty exciting as it's extremely timely. Diversify investment holdings is a rule to live by, or it is no longer the case. More than likely, it'll be one of the best debates that we've ever had on our podcast. I can think of very compelling reasons to throw out one of the two most important rules of thumb that investors should live by. Let's start today by introducing my panel. Today's debate is going to be manned by individuals from two separate generations. We're going to call them old school and new school. Today we have a friend of mine heading up the old school team. Brett and I have known each other for over 30 years. We both started at Fidelity Investments in the early 1990s, and we have a lot of history, and I very much look forward to hearing Brett's insight today. Will do. For team new school, we have Matt Ringle. This is also not Matt's first rodeo or appearance on Money Talks
with the Wealth Whisperer.
I've known Matt for over a decade. Matt started working for me, as I noted, more than 10 years ago as an intern from the University of Cincinnati. Now he is a managing partner of my investment advisory firm. He has completed his undergrad, his master's in investments. Yes, there is such a thing as master's in investments, and yes, it is true. I have never heard of that, as you had not heard of that until we learned about Matt's background. The University of Cincinnati has a master's degree in investment. And Matt has also gone on to attain a CFP in the same 10 years. Welcome, Matthew.
Thanks for having me, Rob.
Okay. As I spoke to, today's discussion is going to be about what I would call the rule of thumbs normally to live by. And one of the two most important rules of investing to me is diversify, diversify, diversify. The other, of course, being buy low and sell high. So we've just lived through a very unique 15-year time period where your level of return was dictated very heavily about the strategy that you employed. You know, historically, people that have done the best investing are people that put valuations or reversion to the mean at the top of the variables they looked at when they would make an investment decision. If you had done that the past 15 years, let's just say you would have made a lot less money than most other investors, whether it be the diversified investor or whether it be the momentum investor. So a lot today, what we'll talk about is diversification versus momentum. So I want to start today with Matt. As I noted earlier, why I can see why one would argue against this long-trusted rule of thumb, but why can I put forth the argument that one should no longer diversify, but should instead invest in the Spectacular 7 or the S&P 500 and move on with their day?
Yeah, great question, Rob. And as you alluded to, this is a very timely topic because this is a lot of what people talk about when they talk about investing, and it's in and of itself. Reminder for everybody listening is this is not the first time this debate has happened either, right? There's been many debates going on about these particular topics throughout the history of investing. So I'm just very excited to be able to talk about it today. So,
what would you know about history?
Yeah, just a little bit.
You're barely 30 years old. Here's what you know. Buy stocks that went up yesterday.
That's right. Well, and that's my argument today.
That's all you've been exposed to.
That's right, and that's my argument, right? So, when we're talking about this subject of diversification versus momentum, the two arguments that I'm really going to use today is innovation and revenue growth, okay? And what do I mean by innovation? I mean, how does a country create an environment that brings and attracts companies to itself that create the newest products, innovate the newest technologies, and bring about the greatest services?
I think that's great because I've heard someone in the past actually call the United States the land of innovation, Europe the land of regulation.
Yeah, and that's exactly right. And that's the two keys, because when it comes to attracting innovative companies, you got to do two things. Number one, you have to compensate those individuals or those companies monetarily, right? And the second one is we have to create an environment of deregulation that allows those companies the freedom to operate and buy other companies and grow their revenue, their bottom line. And so when you look at the capitalistic economy of the United States, it's been proven over history to be the best mechanism for delivering monetary compensation for those that work hard and those that innovate.
So, Matt, what I'm hearing is if I think back 30 years ago and you would hear conversations of historically the United States has lagged to a certain extent. I think I could tie this all together now, though. I could tie it together that 30 years ago, people would talk about emerging markets. And emerging markets back then were truly emergent. So you would take people that were fully destitute and you'd bring them to lower middle class. And the level of growth that can be generated, but that ultimately once it became of any level of developed nation, it appears now, thinking in my seat, is now so much more has to do with it. Is there a rule of law within those borders, and those types of things? So yeah, it's interesting. I think first and foremost, growth still remains an incredible, important variable. As can be tied to maybe what we've seen in India the past handful of years is it is now growing far superior to any other either, minorly developed country. Okay, so back over to your point.
Yeah, so the point, talking about innovation, talking about deregulation, people may ask, what does innovation have to do with stock growth, right? Well, if you think about it, the whole purpose of being an investor is to put money into a company that you're assuming is going to create a new product or service that's going to make that company more valuable and ultimately raise the stock price. That's the whole concept of investing. So without innovation, you're not going to be a very good investor. So when we're talking about innovation within the country of the United States and how that's done versus, let's say, Europe, for example, I got some statistics here with me. The U.S. market has outperformed the international market by over 2,500% in the last 50 years. Even more recently, the U.S. market has outperformed by over 200% over the last 15 years.
To give some context to that, it's not just a stock market. I don't know if you have this number. If not, if one of you guys over there can get this to me, this would be absolutely fantastic. If we were able to go back in time, do you have a time where the GDP in Europe and the United States was relatively close and how maybe that may differentiate? Because I know that you and I at some point have had that discussion.
Yeah, and I have a statistic, actually was going to share that here next, is over the last 15 years. So 15 years ago, the GDP for the United States was right around about 15 trillion. The GDP for European countries, was right at 14.6 trillion.
Pretty much about the same.
Pretty much neck and neck. Since that time period, the GDP of the United States has grown by 82%. It's now $27.36 trillion. While at the same time, the European market or GDP has only grown by 17%.
Yep, so we're not talking market 17 fans, people that are listening. We're talking GDP. So this is totally different, and that lends towards Matthew's argument is that stock returns should follow with GDP growth, and it sounds like it has.
And it really has. And it's no wonder that when we look at the top most valuable companies in the world, 8 of the top 10 reside in the United States, and 33 of the top 50 also reside in the United States. So we're seeing a concentration of the most valuable companies in the United States because of the fact that they can innovate and the fact that they can grow their business, and ultimately that expands the U.S. economy and the U.S. GDP.
Matt, that's all been great, and I'm going to tell you, it's been compelling. Close your argument.
Yeah, my closing argument really is we talked about innovation. Let's talk about revenue growth, okay? Got some statistics here to share with you all of U.S. large cap stocks versus European stocks, okay? U.S. large cap stocks over the last 10 years have grown their revenue by over $3 billion in the last 10 years. What has European stocks done over that same time period? They have lost $300 million in revenue over the last decade. If that doesn't tell you where the focus of growing companies is at this point in time, I don't know what does.
All right, good.
But Matt, What I've heard about large cap stocks are.
Ah, that's a good one. Thanks for
Thank you.
All right, Brett. You're up against the wall. But you're also standing up for our
Our
generation.
generation.
Yeah.
Yes.
All right, question.
Gen X.
Why is diversification maybe even more important than ever? I'm looking forward to hearing about the power of reversion to the mean and whether it still holds water.
I think it does. We have a compelling argument coming. So what I want to do is actually go back in history a little bit and talk about a company that we all know locally here, General Electric. Okay? A lot of folks in the area have had General Electric since 2000 to 2020. If you actually retired with GE stock and that's it, you would have lost 70% of your money over that time frame. And that's just in one stock. What we highly recommend is when you're building a portfolio, you generally want to keep your allocation to stock to between 5 and 10%. It seem fair?
Yeah, I also have one question. We have some of the production crew being under 25 years old. I'm not sure. Have you guys heard of General Electric? Oh, they have. Okay. Well, good. All right. They are making a comeback. General Electric Aviation.
Yeah, aerospace.
Aerospace. Sorry. Look at you guys. Excellent. I don't have to pay you now because you talked on. Oh, that's right. It's not real TV, so I don't have to worry about that. Back to you, Brett.
Excellent. I also want to go back in time a little bit towards the 90s. And for the folks that know in the 90s and early 2000s, there might be this thing that came out that you are aware of called the Internet of Things.
I've used that once or twice.
Absolutely. It's a fabulous tool. I don't know if it's going to catch on.
.com.
Yeah, absolutely.
I'm going to go home and I'm going to sign on Netscape when I get home tonight.
Excellent. Get AOL and dial it up for you. So going back then, it was basically when Rob and I started at Fidelity in the early 90s. It turned out to be one of the biggest bull markets in the history of the country.
Biggest I've ever seen in my 30-plus years, clearly, without question. S&P, I think, did more than 20% 4 or 5 years in a row.
Right. So what happened is a collectively small group of stocks grew exponentially over time. Tend to be tech stocks at that point. Well, guess what happened in 2000? Sure, the folks who are around then know or are fully aware. Technology stocks, if you had everything in there, and back in those days, a lot of investors went the wrong way and said, I'm going to follow the things that are going up the most. Well, if you did that at that point and held it, you would have lost 80% of your money in technology stocks.
Technology stocks dropped by 80%. Yeah, the S&P probably was 50 or 60, which was way more than probably one would have experienced if they had any level of diversification.
Right, and that's what we're talking about is diversification. You want to have it across not just technology stocks. You want to have growth stocks. You want to have value stocks, international, small, large, across the board. And what happened in those times is people did not have it.
And why do you, if you can, I consider myself a student of it. Why does one want to have exposure to all those categories?
Well, it's the old adage, don't put all your eggs in the one basket. If you put them all in, like I said, GE, you were down 80%. But by picking different parts of the market, they work together as a team.
So what it comes down to is I know that we got a lot of people that would deem themselves mathematicians that listen to our podcasts. You don't have to be a mathematician, but if you have any level of, business degree, you at some point have had to take statistics. So there's something in this industry called the efficient frontier that I bought into a long, long time ago. And so in essence, the efficient frontier is a concept where you think about the bell curve. And the top of the bell curve is your most likely outcome. And so the argument that is going to come from Brett is that the purpose for diversifying is to build a portfolio first and foremost that gives you the ability to get the best chance of achieving your target return at the lowest risk level possible. And we're going to give Matt more time saying, yes, I hear that, but if you want to pick up upon that, you have any data points for us?
I do, actually, Rob. So looking at 2000 to 2007, we all know what happened in 2008, the Great Recession. But if you look during that time frame of 2000 to 2007, S&P large growth went down 30%. Small caps went up 155. Emerging markets went up 312. And international stocks went up 150. So for the folks that were in just large growth, they were devastated. But if you had these other categories within your portfolio, it minimized that. It didn't eliminate it, but it minimized that. And to your point, it gave the greatest chance of a return by hitting all those buckets.
So one thing I'd also share with the audience as it pertains to that is it led to one of the most important inventions in my industry over 50 years or more. Is the worst example that I can think of is that in the late 90s, CEOs and HR departments all of a sudden thought they were investment managers. And so the product group specialist would come on site and have a meeting with the executive team in terms of the picking of the 401k. And I can't tell you how many times where I had to look at people's portfolios in the early 2000s and be like, in your 401k, you had 4 different funds or 6 different funds. And you know what? A majority of the top 5 holdings were the same. So all these people were just populating these 401k menus with funds that in essence had been the best performers. Well, one of the easiest things to realize is if I have a whole bunch of diversified things that are all top performers, chances are they're pretty much all holding the same exact thing. And so it was just a debacle. And so it really led to the advent of one of those target retirement funds, which now dominate the 401k space. And those funds are 80-90% just based on the efficient frontier. And so what I tell people often, I say at least 80% of people in 401ks have no business picking their own investments themselves. And so for those individual target retirement funds work great. Honestly, maybe once you get over the age of 50, then there's lots of reasons why maybe they may not be as appropriate anymore. All right, Brett, obviously I've been cheating towards you in the
As you should. As you should.
Well, we are both old school.
Gen X.
All right, put your best foot forward. Give me your closing argument.
Rob, thanks. I do have a couple of arguments that are going to support the closing statement here. One of them has to do with something you brought up, reversion to the mean. And for the folks that don't know what that is, it's the tendency of over a large period of time is prices coming back to their historical averages. If they run up a lot, they tend to come back to their historical averages. If they've been down a lot, they tend to come back up. One specific one talks around the Russell 1000 Growth Index. So the average price to earnings ratio since 2000 is 24.1%. Today, it's 36.5.
Okay, not percent, but price to earnings. Got it.
Yeah.
So substantially above historical norm.
Absolutely.
Okay, and as a counter to that,
I'm going to say that.
How about give me another category? Do you have anything in the small space or international space? Anything else that you can give some context? Because if it's all overvalued, what's that worth? We should all maybe just give up.
Absolutely. I do have statistic around value stocks. It's the Russell 2000 value.
Small cap value. Got it.
Yep. The average since 2000 price to earning ratio is 14.9. As of January of this year, it's 11.0.
All right, so one's maybe 50% overvalued. The other is maybe 20% undervalued. We look at price to revenue, but it's hard to get that historically. Sometimes you can find price to book out there.
I do have price to book.
Awesome.
On the Russell 1000, the average since 2000.
There's Russell 1000 growth, though. We're trying to focus on.
Yeah, sorry about that. Got the growth. Yeah. The average since 2000 is 5.8. Today, it's 20.4. No. Oh, that is right. Jesus. All right, sorry about that.
There goes your argument, Matthew. I don't know. How do we look at these numbers here? All right, we're going to have to check on that. But how about small value?
Small value, the average since 2000 on price to book is 1.4. Currently, it's at 1.3.
Oh, wow. All right. Very compelling. All right, you said you had 2.
I do.
Give me your close. Take the hammer home, Brett.
We're going to go with somebody actually older than us.
That's awesome.
Oh, I know. It's a 65-year-old, okay? They said, the heck with diversification. In 1999, they went in all on growth stocks. They also decided it's time to retire with $1 million. And they said, I'm getting $50,000 a year from that $1 million. If that investor also required inflation distribution of 2.5%, that 65-year-old would run out of money at 77. 70, okay?
Yeah, because 5% distribution rate, if you think about yields in 2000, yields were 5, 6, 7%. So everybody was comfortable with a 5% distribution rate in 2000. So this person doing a 5% distribution rate runs out of money at age 77.
Well, guess what? The diversified investor, the smart one, they still had over $900,000 when they were 78. 0 versus 900,000. I'm going to go with 900,000.
Do you have a breakdown on what the diversification is so that people at home sort of get a feel for what an efficient frontier portfolio could potentially look like for a 65-year-old?
Absolutely. We have about 35% that would be in the bond market, about 35% in large cap companies, 12% in international, 4% in emerging markets, and about 14% in small cap value would be an index.
Okay. Interesting. I'm not saying that's the exact efficient frontier. Obviously, part of this was trying to give you something that did exactly what I talked about before. Best chance to achieve your target return to lowest risk level possible. But we, of course, played with the numbers a little bit for today's, because I think, in essence, when something like that hits you in the face like a frying pan, it starts to drive things home. But to be honest, I'm not going to poo-poo Matt's. I think that's what you hip kids, that's words that you guys use these days.
Yeah, it's not a word I would use, Ralph.
Oh, really? Okay. I've tried to teach my daughter hip-hop belly flop. I keep trying to make that the new saying, but I first tried with my daughter who's now 25, didn't work. My daughter who's 10, neither one, but.
Maybe the viewers will start using it.
Now that I have this podcast, hip-hop belly flop, say it, and all the cool kids will start saying it. All right. So, Matt, do you believe that the goal of an investor is to make the most money they can, regardless of risk?
I think some people might think that's the purpose, but I don't think that's what investing is about. Investing, or being a long-term investor, is about earning a consistent return over time, right? So it's essentially making yourself, if you're going to be a long-term investor, making yourself a pension fund manager. The whole idea here is not to try and hit home runs with your entire portfolio. It's to build it out efficiently
Through diversification?
Through diversification in order to achieve your target return for the least amount of volatility possible, and do that consistently. Because if you can do that consistently, when the time comes for you to actually need money to withdraw from your portfolio, it's going to be there. Or at least, I should say, history tells us it should be there.
Okay. So tie that into your argument, though. Can you somehow talk a little bit about how you could do some of both?
Yeah, we can fit that in, and I think it goes back to a process that, Rob, you created here at DLAC and that we continue to follow through, and it's the 3-step approach to how we look at picking certain investments, right? We've talked about valuations. There's been a lot of metrics thrown out by Brett about where we are from a valuation perspective with certain segments of the market, but that's only one facet of the investment strategy, right? We have to think about things like economic conditions, but more importantly to this conversation is momentum. You threw it out earlier in the conversation that if you were a diversified investor, you would have grossly underperformed over the last 10 to 15 years. And that's an accurate statement. And the reason is because just because something's cheap doesn't necessarily mean it's going to outperform tomorrow, right? It could take some time for that rotation to take place. And if you completely ignore momentum, you could miss out on large amounts of gains from things that could particularly be maybe even a little bit expensive right now.
That's what I've seen, and to either of you gentlemen over time, is I've seen people that I have a lot of respect for fail miserably over extended periods of time, both the late 90s and the past 10 years, where they do magnificent research, send it to me, and in essence come to the conclusion purely based upon valuations. To what Matt said, Brett, if you're willing to take it from here, what we differ from, and we preach, and on the podcast I'll preach it to you, momentum is the third variable. So if momentum is the third variable, how do you take advantage markets going up and then protect markets going down, all based upon the concept of momentum.
Momentum is a very important part. And let me tell you a little bit about how we use that in our portfolios. What we do is we generally take about 50 to 60% of our clients' portfolios. Well, you talked about this earlier, put it in cost-conscious, tax-efficient diversifiers to spread the risk around across many different sectors, segments, etc. The other 30 to 40%, you absolutely want to take advantage.
Or 50. We want to equal 100 here.
Absolutely. Thank you.
We're world mathematicians.
Yeah. Common Core math. Yeah. So what we also want to do is take 30, 40, 50% of our clients' assets and take advantage of the market, which tends to be times when there's momentum. That's one aspect of where we'll take that portion of our clients' portfolios and put it into stuff like that.
All right. So, Matt, what do we do from here? So now that your argument, I'm not saying it's doomed to fail. I'm saying it's potentially long in the tooth. What is a prudent investor to do to not end up like that guy who ends up running out of money 12 years into retirement when his distribution rate is only 5%?
You know, Robin, this is important because this doesn't get talked about enough, is being a good investor is not just about when and what you buy, but it's also about when and what you sell, right? So when we get these trends of momentum that are kind of getting a little bit longer, when we're seeing valuations that are starting to get stretched, it doesn't necessarily mean we need to sell all of it, right? We have to have some triggering event to knock off that momentum to really give us a sign to sell the whole thing. But what you should be doing is you should be taking your profits, right? As things are going up, you should be selling part of that asset. You should be re-diversifying that asset to protect it for if it begins to drop and go down.
No one's ever gone poor by locking in gains. I've heard that many times in my history.
That's very true, yeah.
Great. All right. Now that we've provided both of you with the opportunity to put forth your best argument, it is time to pick a winner. It is old school. All right.
Yes.
Well, unfortunately, I was the only judge here involved, and I still today believe strongly in diversification, the efficient frontier, building a portfolio that gives you the greatest ability to achieve a target return at the lowest risk level possible in a very cost-conscious and tax-efficient manner. Great caveat, Matt. Do you have anything else to add?
Well, I just had, Rob, I put forth the argument, but I have to agree with the old school as well, right? If you got a master's degree like I do in investments, they still preach and teach the efficient frontier. It's been tested over time. I know trends take a little bit longer this time around, where it's been 10 or 15 years when historically they're closer to 3 or 5. But eventually, based upon what we've seen in history, one would expect there to be some reversion to the mean, and diversification is still king.
Fantastic. I want to thank everybody for joining us today, and I look forward to seeing you all again. We'll see you next time on Money Talks.
With the Wealth Whisperer.
For all podcast or guest-related questions, please email us at dlacadvisors@dlacadvisors.com. For all questions or inquiries into the services that are provided by DLAC Wealth Advisors, please contact us at elliot.singer@dlacadvisors.com. That's Elliot with 2 T's. Please also visit our description for helpful links.